So you look at the stock market, you see the headlines, new highs. It's super easy to think everything's just peachy, right? But, just like when a doctor checks your vitals, the real story is often underneath the surface. And that's what the pros do. They have these specific indicators they use to check the real health of the financial system. And today, that's exactly what we're going to do. We're going to decode that health report together.
All right, so this really gets to the heart of it. The market's up, sure, but does it feel strong? Does it feel resilient? Or does it kind of feel, I don't know, a little risky, a little fragile? To figure that out, we can't just look at the price. We need to give the market a full-on health checkup. We're going to look at its vital signs.
And how are we going to do that? Well, we've got this awesome toolkit. It's a set of 7 vital signs that the experts, the analysts, they all use to spot problems that you're just not going to see in the headlines. This is basically our roadmap for this whole breakdown.
Okay, so here's the checklist. We've got breadth, correlation, leverage, liquidity, narrative, funding, and volatility. Now, each one of these tells us a totally unique story about how stable or unstable the market really is. We're going to go through them one by one and build out the complete picture.
All right, first up, part 1. Let's call these surface-level symptoms. These are the things you can spot pretty easily. There are first clues about what might be lurking just under the hood of those big index numbers.
So first on the list is market breadth, and I absolutely love this analogy for it. Think of the market as an army. Is the whole army advancing together, or is it just a few big, powerful generals leading the charge while everyone else lags behind? See, a healthy rally has really broad participation, but when it's just a handful of stocks doing all the heavy lifting, well, that whole structure is a lot more fragile.
And check this out. Here's our first diagnostic. The data for the NASDAQ is, well, it's pretty wild. The index is hitting new highs, right? But get this, less than half of the stocks in it are even trading above their 200-day average. That's our few general scenario playing out right there. And it means the market is super vulnerable if those leaders happen to trip up. So the verdict on this one? Definitely an elevated warning.
Okay, next up, correlation. What is that? It's basically a measure of how closely different things, like stocks and bonds, move together. Ideally, you want low correlation. Why? Because that's what makes diversification work. If everything just goes down at the same time, well, there's nowhere to hide, is there?
Now, the story here is a little more complicated. Lately, we have seen the link between stocks and bonds weaken a bit, which is good. That's a positive sign. But, and this is a big but, experts are pointing out that the whole system is still really sensitive to any big economic shocks. One of those could make everything fall in lockstep again. So for now, let's call this one neutral.
Okay, let's keep going. Time to dive a little deeper. We're moving into part 2 now, the under-the-hood pressures. This is where we really start looking at the market's guts, the financial plumbing that keeps the whole machine running.
All right, indicator number 3, leverage and crowding. I think a great way to think about leverage, or debt, is like fuel. A little bit, it can power some amazing growth. But too much, well, it can get really, really explosive. And crowding is exactly what it sounds like. It's when everybody piles into the exact same trade. And that's super risky, because if something spooks the herd, they all rush for the exit at the same time.
And wow, the numbers here are pretty eye-opening. So U.S. margin debt, that's money people borrow just to buy stocks, is over $1 trillion. And at the exact same time, you've got the big players like hedge funds making these massive near-record bets that things are going to stay calm, that volatility will stay low. That combination, tons of debt and everyone making the same bet, is a huge red flag. This one goes firmly in the elevated warning category.
Okay, now let's tackle 2 indicators that are really closely linked, liquidity and funding. If we're sticking with our analogies, and leverage is the fuel, then you can think of these 2 as the market's circulatory system, the blood flow. Liquidity is just how easily you can buy or sell stuff without crashing the price. And funding is basically the availability of cash and credit to keep everything moving. And let me tell you, any stress in this part of the system gets experts really, really worried.
In this quote from Michael Howell, it just nails the concern perfectly. He's a top expert on this stuff, and he's warning that the Fed's policy, combined with this huge wave of debt that's coming due, it could cause a liquidity crunch. Basically, he's saying that the financial plumbing, that circulatory system we talked about, could get seriously clogged up.
So look, there isn't some big crisis happening right this second. But the key takeaway is that the stage is being set for trouble down the road.
The global liquidity cycle seems to be hitting its peak, and we're seeing all these weird signals in the bond market that point to funding problems ahead. So yeah, both of these vital signs are definitely in that elevated risk zone.
Okay, so we've looked at the market structure. We've looked at the financial plumbing. Now for part 3, we're going to shift gears to something totally different, but just as critical, the market psychology. Like, what's the mood out there? How are people feeling? And how is that creating risk?
And what we're seeing is this really deep split in the market. On one hand, you have the algorithms, the computer-driven traders, and they are positioned for record highs. They are super bullish. But then you look at the humans, the discretionary fund managers, and they're getting more and more bearish. It's this huge disconnect in what the market thinks.
And that kind of split, it creates a really dangerous mix. Let's break down what that is.
Okay, here's the combo. It comes down to our last 2 psychological indicators. First, there's this one single, incredibly powerful story, the AI narrative. And it has basically pushed everyone into the same small group of stocks. And second, the market's so-called fear gauge, the VIX, is sitting at these super low levels. Now, you might think that's good, but experts look at that and they don't see safety. They see dangerous complacency. And yeah, the diagnostic report really seals the deal here. That dominant AI story, it's a huge risk because of all that crowding we talked about. And the super low volatility, with the VIX way below its long-term average, that's another big one. This whole calm before the storm feeling, historically, it often shows up right before a big market shift. So yeah, both of these indicators are absolutely flashing red.
All right, we've gone through all 7 vital signs. We've looked at the surface level stuff, the plumbing underneath, and even the market psychology. Now it's time to put it all together and give our final diagnosis.
So here it is, the complete health report, all in one place. And when you look at it like this, well, the evidence is pretty clear, isn't it? We've got 6, count them, 6 indicators all flashing an elevated warning. Everything from the narrow breadth and record leverage all the way to the psychology of a single story and no fear. The only one that's not screaming danger is correlation, and that's just neutral.
And this chart just makes it crystal clear. Out of 7 vital signs, 6 are flashing warning signs. 1 is neutral, and 0 are benign or signaling safety. The takeaway is immediate. The market's underlying health is showing some pretty serious signs of fragility.
So here's the bottom line. Our health checkup shows a patient, the market, with a whole bunch of elevated risk factors. But here's the thing. A diagnosis isn't destiny, right? It's a warning. A market can stay fragile for a really long time. So the real question isn't if the market is fragile. Our checkup shows that it is. The real question is, what's going to be the catalyst? What's the spark that could turn all this fragility into an actual crisis? And that is what we should all be watching for next. Thanks for digging into this with me.